Hey, you're looking to start investing, but you don't even know where to start? Maybe you don't even know a thing about investing, but you know you want to be wealthy in the future? Well, I put together this video myself just for you, and at the end of this video, you'll be investing just like a pro in no time. In fact, I actually used a certain strategy to invest for myself and my parents. And even though this investing strategy is made for the long term, last year myself, I actually peaked at 20%. Let's see how I did that right after this. Step number 1, we have to open a brokerage account. First of all, what is a brokerage account? A brokerage account is simply an investment tool that allows you to buy and sell varieties of investments. This includes bonds, stocks, could be REITs, ETFs. There's 2 beginner-friendly brokerage accounts that I recommend for starters, and number 1 is Robinhood and number 2 is Webull. All you have to do is go on the App Store or the Play Store and you go ahead and download those apps. Once you get these accounts downloaded, all you have to do is register for an account. Now keep in mind, you may have to send proper ID, maybe like a picture of your driver's license or a passport, just so they know that you're actually the real person that's signing up for this account. Every brokerage account needs to have proper identification, so it's just part of the process. So once we send that, you usually have to wait a couple days and it'll approve your account. Okay, so now we have a brokerage account. Now we can move on to step number 2. Step number 2 is just simply to buy ETFs. First of all, let me explain what an ETF is. An ETF stands for Exchange Traded Fund. Think of it like a whole basket of stocks. If you go to the store and you want to buy a certain chocolate, like let's say milk chocolate, you can buy individual milk chocolate, for example, like Hershey's. However, if you want to buy an assortment, sometimes you can buy a bag of Hershey's that have almonds, they have dark chocolate, they have all sorts of chocolate. So buying an ETF is simply, instead of buying just one particular stock that may crash or go down and you don't know the uncertainty of it, it's better to be safe and buy an assortment of stocks. And these assortment of stocks are not limited to just 5 flavors. It's more like 100 to 500, even thousands of stocks in one ETF. The reason why we want to buy ETFs is that overall the total stock market tends to go up on average 9% every year. So with that said, if you own most of the stocks in the stock market, you can probably expect around a 9% gain in your portfolio every year. Now, given that's on average over the last 90 and 100 years of the stock market, keep in mind that there'll be some years where it's going to be down, but there'll be other years that will offset how much it went down. So this is why the goal is to invest long term, because on average, our portfolio should grow with the stock market. Now, this is where you do your personal research on especially some of these ETFs and stocks. Now, remember, I'm not a financial advisor, so don't take this as financial advice. Now, my personal favorite 5 ETFs are FTech, VGT, QQQM, SCHD, and VOO. Now, last but not least, remember, Warren Buffett once said, the number 1 rule in investing is to never lose money, and the number 2 rule is to never forget rule number 1. Now, step number 3, we want to dollar cost average into the stock market on regular intervals. Now, there are other ways to invest, but I prefer dollar cost averaging because it takes all the emotions out of investing, and it also is the more suitable route for many people, as they don't really have a huge lump sum of money when they start investing. We all work day-to-day jobs and we get paid maybe every 2 weeks or twice a month or once a month, and that's where we get our money that we can invest with. This works really good with dollar cost averaging because we're constantly just putting our money into the stock market, and money in the market beats timing the market. Dollar cost averaging has also freed up a lot of my time and stress away from the stock market, so I can just go on my day like normal, just go to work, go spend time with my family, friends, anything, and just forget about it. Now, for example, I'm gonna show you guys how to dollar cost average onto Robinhood and Webull apps. So I'm gonna open up my Robinhood app here. Again, I'll get to Webull just in a second. It's gonna log me through. And here we just want to go to the search bar in the top right. Let's search a ETF that I particularly like. So let's do fintech, and this is Fidelity's. You can see right there, Fidelity's Information Technology Index. This one tracks 100% technology stocks, and I'm definitely a technology kind of person. So once we're on this page, you can see fintechs. You have the day, the week, the month. Looks like this month is the down month. But year to date, looks like it went up quite a lot this past year. So we're gonna hit trade here, and we're gonna hit buy. So here, open up a very simple dialog. You can just hit how much you want. So for this example, we're just gonna do 100. But instead of hitting the review and just a normal buy, we're gonna hit the very top right again. It says dollars with the down sign. And over there, you see there's conditional orders. On the first one, it says reoccurring investment. That's the one we want. hit that and see there, we can click any kind of frequency you want the recurring investment to happen. You can do it every day or every market day rather, which is basically 5 days a week. When the stock market's open, Monday to Friday. We have every week, every 2 weeks, and every month. Let's go ahead and leave this one as every week. Continue, and then you hit that. And here it will just tell you basically what payment you want to use. You can withdraw directly from your checking account, which is your bank account, or you can have use the money that's in your account on the brokerage account. So once you do that, you're all set. I'm not going to confirm because I don't have any money on this account. This is how you set up basically a recurring investment or dollar cost averaging strategy on Robinhood. So next we're going to go over to Webull. So I'm going to close out of here. So I'm going to go over to Webull. I just opened the app. Now I do have an account in this app, so I'm already preloaded in. But if you don't have anything, you again, just like the other one, hit the search bar. Let's go ahead and search fintech again. There it is. For 1 year, again, you can see the 1 month was pretty down for this year, but similar graph to Robinhood. Now to do a recurring investment, you actually hit the ... which is in the bottom right. So not the trade one, but the ... down there. And then the first option for recurring investment. It's gonna sign me through. So just like the other one, you hit how much you want to dollar cost average in. So you're gonna hit 100 here, and then we're gonna hit the frequency, which is right under the schedule right there. You can see right here, it just has the same exact options basically as Robinhood. Now personally, what I do on my investing strategy is I actually prefer the dynamic dollar cost averaging, which is actually a range of money to use. So on Webull, on Robinhood, they don't have dynamic dollar cost averaging yet, but on Webull they do. And this is what I do on my account is on the fixed amount, I rather click the dynamic amount. So what it does is it compares the current price of the stock or ETF that you're buying, and it compares it to its moving average. So basically down here, you can see it says this symbol, it compares it to itself. I prefer the 120 because that's only 6 months of trading. So for example, if the current stock or ETF is trading or its price way higher than its moving average, then it assumes it's on a peak, so it actually buys less of the shares. Now, if it's trading at a very low price compared to the moving average, it's actually gonna buy and pick up more. So where we can see that is where we just hit in 100 near the top. Right under it, it says it varies between $50 and $200. So if I were to set this up and enter this in, it would buy anywhere from $50 to $100 worth of fintech every Monday. Now I really like dynamic dollar cost averaging because it buys the dips automatically for me, and when it's peaking, it doesn't buy as much. But when it dips, let's say fintech goes really low, you know you want to buy more so you can get a better price. So dynamic dollar cost averaging will actually buy more shares when it dips. So overall, I think it's actually a superior method to dollar cost averaging. Now, if you don't have access to dynamic dollar cost averaging, don't worry because dollar cost averaging is still just as good. So going back to this dollar cost averaging, we're just going to go to fixed amount here just to show an example, and then we'll hit the next on the very bottom. So here we can confirm our recurring investment for a dollar cost averaging strategy. So I'm not going to click it because I obviously already have dollar cost averaging on the stock, but I'll go to a place where you can see that. You go to your orders here. You can see all my recurring investment orders that I've made over there. Understand that when markets actually go down, it's actually better for you because you are dollar cost averaging in, getting those stocks and ETFs at lower prices and picking up more shares. Every 10 years or so, we usually have a recession in the stock market. Historically, the recessions last 2 to 3 years each, and after a recession, we usually have a bull run that's 7 to 8 years. So right now, if you start investing and the market looks shaky, if you dollar cost average, it's actually a very good thing. If this is where the market crashes, we will be able to buy the dip essentially for the first 2 to 3 years, buying stocks and ETFs on sale. And then for the next 7 to 8 years, we will be able to ride out the increases in the stocks that we bought when they were on sale. This is the best case scenario for a person like you who's dollar cost averaging in the stock market. And the last tip I would say is to ignore any kind of interference, fear, and what the media says. Do your own extensive research and don't just read articles or see headlines that make you emotionally driven to sell your investments. When you first start, it's normal to always want to look at your investments. Sometimes you'll look at it every day or every hour, but as you do this for a long time, you'll realize that you can just let it ride and you don't have to look at it as often. Another important tip is to never deposit too much money into your brokerage account that you might need for something else. Always have an emergency fund or something like a safety net so that you don't have to pull and sell your investments. The funny thing is, if you had to sell your investments, because let's say car alternator blew up or something happened, you'll almost always sell at the worst time and wish you hadn't had to sell. Listen, if you never really invested before and this is your first time, you're going to start to feel the extreme emotions of investing. Like, so if your portfolio starts going up, you're gonna feel all the highs and elated and everything. And when your profile starts tanking, you're gonna feel so miserable. You wish you're gonna sell, you're gonna feel panic and stressed. Again, it's just like riding a bike. The first time you do it, it's gonna feel very, very scary, very nervous. You know, you're very anxious. When you finally get the wheels turning, you get that adrenaline rush. But obviously, you know, if you rode a bike before, the next time you get on a bike, after like 5 years of riding a bike, it doesn't feel like anything. So with investing, it's the same kind of concept. Once you start getting used to the rhythm, and I can speak for this myself, I've done it for almost a year and 2 months now, it doesn't really affect me at all on a day-to-day basis. I still go to work just fine. I don't really look at my portfolio unless I'm just bored and curious, but even then, when I see the number that gets shown back at me, it doesn't cause any panic or any emotions. Now, if you found this video very helpful, please hit that like and subscribe button. You can also keep up to date to my portfolio to see what are my returns, and you can see whether or not my parents disowned me for investing their money. Click on my next video right over here. When I started out, I wish I knew these 4 things. Please don't make the same mistake as I did. And that's it for this video. I'll see you guys in the next one.